the paper is going to focus more on complex consolidation. But consolidation as it is in itself, in terms of its principle, the underlying principle, nothing has changed. It's still the same thing. Okay? So what we would do now for this class is to go back to the foundation and try as much as we can to bring ourselves back to speed on some of these, adjustments and principles that we had earlier learned when we were doing simple consolidation. Okay, so now really what is consolidation? We were speaking on group structures last week, and we focused more on, my explanations were focused more on the parent subsidiary type of group structure. We said a parent is any entity that controls another entity, and a subsidiary is anyone that is controlled, any entity that is controlled by another entity. Okay, now you see, a consolidated financial statement, a typical one, I would have loved to share one, but we have access to many group financial statements online. What is the content? You will see first of all, the parent company financial statement, which will state what are their investments in subsidiaries. If they have more than one, they are going to tell you, they are going to give you a list of those subsidiaries. They are going to tell you how many shares or what is the percentage of holding that they have in those companies. Now, what is the amount of their investment in those subsidiaries? So they are going to list them out in the parent company financial statement, meaning that I'm going to have sometimes it's combined, most of the time, more often than not. So let's say the name of the group is, let's say it is Exco. You will have that of the company. You will have their financial numbers, and then you have that of the group. You will have the financial numbers. That of the group would have been consolidated. This one giving you that the numbers for the company is giving you the financial numbers that pertain only to the parent company. Okay. Now, where that is done, what I was explaining here is that the parent company in that consolidated financial statement would have made known to you the number of shares, the percentage of holding that they have, and the amount of investments that they have in the subsidiaries that they have consolidated their numbers. So that is why you will see on this aspect, you will see investment in subsidiary, you will see the number, apart from this, what is it called now? These declarations that you would have seen. Where the numbers are, you're going to see on asset side, you'll see investment in subsidiary. And then on the statement of profit or loss, you're going to see the income or dividend that they have gotten from their investment in those subsidiaries. Okay? Now, the other things that you're going to see will be consolidated financial statement, consolidated statement of profit or loss, and OCI, consolidated statement of cash flows, consolidated statement of changes in equity, and then the notes to the financial statement. Okay? Now, we're going to look at what is the procedure. I always say this, there are only two major overarching principles for you to deal with consolidation rather. What are the two overarching principles that you must follow? Very easy. If the companies, that is the parent and the subsidiary, have had any transactions, if they have had any transactions, those transactions must be cancelled out when you are drawing up the consolidated financial statement. Those transactions must be cancelled out. And the simple ideology or the simple common sense behind that is the fact that when you are presenting a consolidated financials, we are doing it with one thing in mind, that both the parent, the subsidiary, and every other party that has an investment in the subsidiary, which you must have been told in FR that they will be called non-controlling interest. All of them, what you call a consolidated financial statement means that we are assuming that they are one company. Now, if it is one company, it will be impossible for company A, which is a parent to company B, to have financial dealings with company B. It will be impossible for them to have a transaction together. The reality is that they do have a transaction. However, because we want to produce a consolidated financial statement, we must cancel out those transactions when we are presenting a group account. Number two is that once we have cancelled out those assets and liabilities that have been traded between these parties, these group parties, the next thing to do will be to now add line by line items. These are the two overarching principles that you must know and follow all through. Everything you're going to learn is based on this foundation. And we're just going to quickly revise. We'll pick it up a bit fast because it's a revision of what we've done. In the next class, we'll go into complex structure. But I want you to pay attention. This is your opportunity to go back again and lay the foundation so that you have a solid understanding of what you're going to be doing in the coming weeks. Okay? Now, we're going to take a very simple case study here. Very, very simple case study. PICO acquired 100% of the equity of ESCO since its incorporation of ESCO. The statement of financial position of the two companies on 31st December 2017 are given below. You are required to prepare the consolidated statement of financial position of ESCO at 31st December 2017. Christiana Alfred, you can go ahead. You can unmute and let me know what the problem or challenge you have is.
Okay, so I wanted to ask if you can restate the second principle.
Okay, the second principle is simple, is to add. You are adding line by line items. The uncancelled transactions, you have to add them, meaning that, for instance, we're going to do that now. Property, plant and equipment, PICO, property, plant and equipment, ESCO, 320,000 and 62,500 respectively. What am I going to do? I am going to add them. In as much as none of the property, plant and equipment items is a trade between PICO and ESCO, I will just simply add them. So that's it's a very, very simple and straightforward process. And it's the same even into the complex structures. So let's start to look at things. So the first question I want to ask myself when they ask me to consolidate is, what are the items that I must cancel out? What are the items that I need to cancel out? Okay, now let's look at it very well. Every time a parent company has made an acquisition, in the books of the parent, you're going to have this line, investment in subsidiary, as an asset, right? This investment they made that investment to purchase the net asset of ESCO, right? Now this 60,000 is the 40,000 ordinary shares and the 20,000 naira share premium that you are seeing here. If I add these two, I have 60,000. Now this transaction, investment in ESCO, is what you have on the equity side of ESCO. So when I want to consolidate, what do? I will first of all cancel out this transaction. And when I have canceled it out, I ask myself, is there any other thing that I must cancel out? I was not given any other information. It's a very straightforward question. So what do? I will simply add PPE 320 plus 62,500. That will give me 382,500. I have cancelled out this line because it is an investment in ESCO and I can see it in investment in ESCO. I've cancelled it out. Current assets would be 80,000. If I add this together, I should get something around, okay, I'll come back to the addition. Now, when I come to equity, I am going to pick only the ordinary shares and the share premium of PICO. Why? Because this 60,000 investment in ESCO, like I mentioned earlier, I cancelled out the equities in ESCO. So I will have here 100,000. Sorry. Let me erase this one as well. I will have here 100,000, share premium 125,000, retained earnings 175,000. You add all of that together, you have 400,000. Then, when I get to current liabilities, there is no transaction that has taken place between PICO and ESCO. So I am good, I am free to add 50 and 12,005. And that will give me 62,500. If I add these two together, my equities and liability equals 462,500. Here as well, I have 462,500. Now, this may be a very simple question, but we have applied that principle of cancellation. Can I move forward? So when you come to the solution, they did exactly the same thing. Now, I will advise you to use this week, especially if you know that your group knowledge is not very strong, to use this week to go back and learn all of these things that has to do with simple consolidation. We may not go all the length solving all the questions. I may have to skip some of the questions so that we can move on and get to the more complex ones. But please pay attention as we move forward. Now let's look at another one. PICO regularly sells goods to its subsidiaries company ESCO. Now you see, he's already telling you that they're having a financial transaction. Okay? Now, PICO has owned ESCO since its incorporation. The statement of financial position of the two companies on 31st December 2017 are given below. And now we have the statement of financial position for PICO and for ESCO. Okay? Now, I can see that PICO made investment 20,000 shares, 1 naira shares in ESCO at cost of 20,000 naira, right? Now, that investment that they made, I want to see it in the book of ESCO. I'll come to the equity side. Abi, this was the investment that they made. This is the 20,000. These two, we apply the principle of cancellation. We must cancel them out when we want to consolidate. So I want to ask the class, is there any other item when you're looking at line by line items of PICO and ESCO that you think should cancel out each other? Okay, thank you. From B, it says receivables and it said receivables and payables. Yeah, if you look at receivables, under receivables in the book of PICO, we have ESCO, meaning that, because they mentioned to us that they have been trading together, meaning that in the book of ESCO, in the book of PICO, PICO is saying we expect to receive 1,000 naira from ESCO. And when you come to the payables of ESCO, you will see here, they also wrote PICO. We expect to pay, or we owe PICO 1,000 naira. These two transactions I am going to cancel out. Once I cancel them out, then I can go ahead and what? And consolidate. And my consolidation will be PPE. I will add 17. Can we all see my screen? And can you all hear me? Can you just use the chat box? Let me know if you can see my screen and you can hear me. I'm very sorry, please. I'm very, very sorry. Okay, let's go on what we're saying. I think we had mentioned that investment in ESCO, 20,000 should be cancelled out against the 20,000 ordinary shares that we see on the ESCO line. Let me use. So we're cancelling this against this, and we're cancelling this against this. So let's quickly do the numbers. Okay, so PPE we add up is 40,000, right? This line we add up is 14,000. This line we add up is 75. This line we add up is 500. When we come here, we only take the ordinary share capital of PICO. We have cancelled this out, so we come here, this is 35,000. Now, retained earnings. Listen carefully. The parent company has a right to share in the retained earnings of the subsidiary from the date of acquisition going forward. What does that mean? It means that if the subsidiary was acquired on 10th December, for instance, the parent will have access to share in the profits of the subsidiary going forward from 10th December. Now, what that means is that all the retained earnings that the subsidiary had retained in their books, all the profits they are retained in their books prior to 10th December, the parent company will have no right to share in those retained earnings. Okay? But now we have a very, very simple scenario here. A scenario where the question told us that PICO, the parent, has owned ESCO since the day of its acquisition, meaning that all the retained earnings that the subsidiary would have generated or would have retained, PICO has a right to share in them. So therefore, what that means is that I am simply going to add up these retained earnings. I'm simply going to add up the retained earnings. it will be 8,000 plus 9,500, and that will give me 17,500. Total equity will be 52,500, right? Bank overdraft, I will add that line to the zero we had there, 15. I have cancelled out 1,000, so I move to others. 7,000 plus 1,000, I have 8,000. Now, when I add all of this together, 0, 0, 0, I have 3, 4, is 12, is 62,000. When I add 7,500 to 5,000, 8,000 plus 14,000, 22,000 plus 40,000. If you do all of this addition, you have 62,000. Okay? And the two will balance. Okay? When you look at the solution, we have done exactly the same thing. Okay? So I'm going to move it further. I will move it further. Let's go to, okay, I think here they're still talking about current assets. Let's push it further. Let's push it further. Okay, now let's have a case that we will typically have in our exam. And what's the case we will typically have in our exam is that the parent company will most likely not own the subsidiary 100%. And like I mentioned, in such a case or such a scenario, the other parties that have equity interest in the subsidiary will be referred to as non-controlling interest. We know this, right? Now, what does that mean? It means that the parent company does not have full access to all the earnings or profits of the subsidiary, meaning that those non-controlling interests, those parties, will also have a share in the profits of the subsidiary. Okay? However, notwithstanding this fact, we are going to treat the NCI, the non-controlling interest, it will be part of our consolidation statement because when IFRS 3 business combination was reviewed, one of the reviews was that NCI should show on the consolidated financial report, position as a separate line of equity, an equity component as a separate line. So what am I trying to say? Even though the parent company may not own 100% the subsidiary, when they are going to be consolidating the group account, they will do it as though they own the subsidiary altogether. However, when they don't own the subsidiary 100%, they will show it on their equity, under equities, non-controlling interest. Now, the value of the non-controlling interest will always be the value of investment of NCI plus the percentage of holding times the retained earnings of the subsidiary. The value of the NCI that was brought forward, then you are going to add the percentage of the holdings of the retained earnings, which is, sorry, the post-acquisition retained earnings of the subsidiary. Now, remember I already juxtaposed between, I already differentiated between the pre-acquisition retained earnings and the post-acquisition retained earnings. So in the book of the parent company, when they are consolidating for group account, this is what they are going to do. Okay, let's see it's done. Let's see it done. Now, at this junction, I want you to pay attention because the more the complex the question becomes, the more you need to be able to find a simple way to take note of the important things. Now, you must have noticed the way the solutions were built. When they are doing workings, you see number one, group structure. What are they doing with group structure? The group structure is to show you how much holding or what is the percentage of holding of the parents in the subsidiary. What is the percentage of holding of the NCI, non-controlling interest, in the subsidiary? Now, second thing, very important, you would have known or you should have guessed it that it should be the next thing, because we must pay attention to the acquisition date. Remember, I told you that when we want to go and share the retained earnings, we will only have right to share in the post-acquisition retained earnings. So this is very important, the acquisition date, because when I know my acquisition date, it will be a cutoff point from which I am going to share the retained earnings of the subsidiary. Okay. The next thing that is very important that we must note is the consolidation date. Now, why is this important? The consolidation date is the date that I am making up the account, the date I am reporting the account. That is what we call the what? The consolidation date. Meaning that my acquisition date could have been 2018, but I am consolidating as at 2020. Let's say 31st December 2020. So this will be my consolidation date. And now what that means is that when I'm going to be referring to post-acquisition retained earnings, I will start off from 2018 and I'll count down towards to 2020. Any retained earnings that they owned before 2018 going to share. But we still have a very since incorporation. Since incorporation means that since the day the subsidiary company was formed, the parent company has always owned it. Now that happens in cases where the parent company is the one that set up the subsidiary company. So it will be from the day of incorporation that they have acquired that company. Okay. Let's move on. And then the next thing would be to figure out what is your NCI. Now, permit me to take my time to quickly mention here that your NCI will be valued using two methods. It could be any of the two methods. It could be any of the two methods. The question will tell you. Now, more often than not, you should expect the second method. Now, the first one is proportionate share of equity of the subsidiary, number one. Number two is the full or fair value method. Proportionate share or full or fair value method. Now, what is the meaning of this? When we say proportionate share, we are still making reference to the book value of the equity of the subsidiary. Now, book value will mean that, let us look at this question for instance. Let's go to the question itself. Remember, they said ordinary shares of ₦1 each. ₦1. So if they ask you what is the book value, the book value will be that this company has 40,000 shares at ₦1 each. So when I do 40,000 shares times ₦1, I'm going to get this 40,000 naira that you are seeing in the, let me focus on ESCO. They have 20,000 shares at ₦1 each. Okay? Now, you will agree with me that the fact that in the books it is ₦1 each, it does not mean that the shares of ESCO in the stock exchange market is trading at ₦1. As a matter of fact, it's possible that it is trading at ₦2.50 per share in the stock exchange market. Now, what is the meaning of this? If share value, if they own 25%, we'll calculate that 25% as 25% of 20,000 shares multiplied by the what? The book price, which is ₦1, times ₦1. And that will give us how much? That will give us 5,000 naira. Very simple and very straightforward. We'll multiply the holdings by the number of shares, multiplied by the book value per share. However, if it were to be full or fair value, meaning that we are going to be paying attention to the what? To the market price. The market price of the shares. How will I go about this? I'll say, in this instance, I'll say 25% times 20,000 multiplied by 2.5. And when I do that, instead of getting 5,000, I'll probably get 12,500. Is this clear? Is this very clear to us? My students, you can use the chat box. Is this clear to us? Okay, good. Now, let's move forward. So if, okay, Adele say I should come again, means that I'm going to value the NCI using the book value. The book value. And I said, how do I know the book value? It's very simple. I will determine the book price or the book value on the account of the subsidiary. I will go there. What is my naira? But I am told it is ₦1 each. So when I want to know the holding of NCI, I will say, what is their percentage holding? 25% times 20,000 times ₦1. But if it were to be the second method, full or fair value, what would I do? I will say percentage holding 25% times 20,000 shares multiplied by ₦2.50 each. This ₦2.50 each we have assumed is the market price of the shares of ESCO at the stock exchange market. Is that clear? Is that clear now?
Yes, sir, it's clear. Thank you.
Thank you. All right. So we can now go ahead and quickly try to, consolidate this very simple scenario we have with us. So now we'll still cancel out. But are we going to have a problem? Because this is 100%. Coming. This is 100% of all the shares in ESCO. But this investment in the ordinary shares of ESCO only represents 75%. Is this supposed to be a problem? No, because we have said that the NCI, the remaining 25%, will be assumed to be part of the group. So we're going to use both the 75% of the parent and the 25% of the NCI to try as much as we can to find a way to cancel out this 100%. And this is how we normally do it. We'll say I'll say this 15,000 cancels out 15,000 here. The remaining 5,000, I am going to show it as NCI, 5,000. What have I done? I have cancelled out the whole of this 20,000. That way, let's go. The remaining 5,000 is showing in my consolidated financial as NCI. No, we don't. Okay, so let me do the job. I'll come here. I'll say PP. Okay, this time around is I think 42.5. When we add the two together, this should be cancelled out. So I'm going to jump and pass. Okay. When we get to current assets, 22,500 plus 17,500. I think that should be, is that 50,000 or 40,000? I think it's 40,000. Altogether, you have 82.5. When I come here, I'm only going to pick the ordinary shares of the parent, 40,000. When I get to retained earnings, now I said the parent company only has 75% holding, right? Meaning that they will not have rights to share all of this 75%. So what are they going to share? They are going to get 75% of 5,000, which should result in 3,750. And that 3,750 will come here, right? And that will be 43,750. But don't forget that we said NCI will come and show here. Why? Because only 15,000 was cancelled out of this 20,000. So the remaining 5,000 will be our what? Our NCI. Now, all our equities will result to 48,750. And then?
Sorry to cut you short. Why are we doing 75% on the 5,000? I didn't get that.
Okay.
Okay, the retained earnings. Oh, I thought it was the remaining shares, the remaining ordinary shares.
The retained earnings, I said the parents will only have access to 75%. Now, don't forget that we said NCI will be the value of the NCI, the previous balance that was brought forward. Now, we know that NCI is 5,000. Now, what of the share that they are going to get, the remaining 25%? We'll do 25% of 5,000. And that should result in how much? 1,250. And that will give us 6,250. When I come here, my NCI will be 6,250. And this is how I'm going to add these two. And I think that should give me 50, is it 50,000? Oh, sorry. The share of ESCO retained earnings for the parent is 3,750, right? But don't forget that the parent company has their own 12,005, right? So I'm going to add these two together. If I add 12,500 to 3,750, I think that should give me, is it 16,250? Let's always come to class with calculator. Now, this should give me 56,250. When I add the two together, I should get, that should be 62,500, right?
Yes, yes, sir.
So the current liabilities, I'm going to add line by line, 10 plus 10, that gives me 20. And at the end of the day, this is also going to give me 82,500. I think because I had to go back once or twice, maybe there's anybody that got confused at any point in time. Is there anybody that missed anything there? Did we all get it? Did we all get it? Can I move on?
Hello, sir. Please, where did you get the 6250 from?
6250. Okay, that's the working we did here, NCI. So don't forget that I said for you to get the value of NCI as at the consolidation date, you will say, what is the original value of your NCI? And then you will add their own share of the retained earnings. Okay? Now, how did we get 5,000? We would have said 25% multiplied by how many shares are in ESCO. If ESCO shares is trading at 1 naira each and the value or the amount of the ordinary share is 20,000 naira, you agree with me that it means that they have 20,000 shares, right? Now multiply that by the book value. Now, when the examiner is quiet, they did not tell you to measure at full or fair value. It means I'm going to use proportionate. Because proportionate is very simple and direct, very natural. Now, if the examiner wants me to use full or fair value, even if they don't tell me the method to use, the minute they give me the market price of the shares of ESCO, then I know I have to use the full or fair value. Right? But that's not the case here. So I'm going to do times 1 naira for each share, and that will give me 5,000. That's how we got this 5,000. Now, in terms of the retained earnings, what we did was to say it is not possible for PICO to have access to 100% retained earnings. You know why? Because they don't own 100%. They only own 75%. So the remaining 25% should go to ESCO. So that 25% multiplied by this 5,000, which is the retained earnings, is what gave us 1,250. We now added that to the 5,000. That's how we got 6,250. All right? That's the 6,250. This 6,250 belongs to NCI. This 56,250, everything belongs to the group, to the parent. Okay? Now, and that's how we get the 100%. What belongs to the parent is here. What belongs to NCI is here. And then we now come here and add the current liabilities, and we'll get 82,500 here as well. Okay, so can I move on?
Yes, sir.
Okay, so we move on. So I think the next question will just be that we have full or fair value. I would just like to show us so that we can see it. So you see, it's the same thing they did here. And they even gave better explanation, there's explanatory notes. So please take your time to go through this material, especially these aspects, Go take your time, read through it, okay? Okay, the next question has to do with goodwill, fantastic. So now, there's something called goodwill on consolidation. Now, you will not see goodwill in the books in the separate financial statement of any company. However, on consolidation, you are likely going to see goodwill. What does this goodwill really mean? It means that when the parent company or the acquirer was doing the negotiation to acquire the subsidiary company, they want to believe that there must have been some reputation, there must have been some maybe market reputation or significance that the subsidiary company has built over the years. And so for that reason, they will be willing to pay an amount that is higher than the net asset of the subsidiary. We're going to see that now. It may sound like plenty English now, but when we demonstrate it with numbers, I believe you will get it clearly. Okay, let's go to the question. We're told PICO acquired the ordinary shares of ESCO on 30th June 2017. When the statement of financial position of each company were as follows, okay? We're told the investment that PICO made in ordinary shares of ESCO is 25,000 ordinary shares of ESCO, and they made an investment of 40,000. Okay. However, when we told they acquired it from inception, they said they acquired it on a particular day. Okay. And what day did they acquire? They acquired on 30th June 2017. Now, let me walk you through how you should do the workings. Let me mention, I've mentioned it earlier, let me mention it again. First of all, figure out what is the group structure. Now, this question did not mention anything about holdings. However, he also did not tell us that ESCO is owned by another company. So the assumption we made is that PICO owns ESCO. My line is breaking. Is that the feedback from every one of us? Are there people who can't hear me? Can we all see my screen?
Yes, sir.
How about the line? Is it still breaking now?
No, we can hear you. I can hear you clearly.
I'm trying to make. In the meantime, let's continue. Okay, so now you pay attention to this and you will notice that we first of all dealt with group structure, then acquisition dates this time around is not from inception. What is the implication of this? The implication of this is that PICO will only begin to share in the retained earnings of ESCO starting from 30th June 2017. However, we are consolidating exactly on that day. Okay. What is the implication of this? Who can tell me what can that mean? You know, we said that PICO will only be able to share in the retained earnings starting from the acquisition date going forward. I mean, but we are also consolidating on that date. What does that mean for sharing of retained earnings of ESCO? Anybody in the class? What's the implication of that? Anybody wants to try?
Please, what was your question?
Okay. My question is this. We are consolidating on the acquisition date. And I mentioned earlier that the parent company will only begin to share or receive the profits of the subsidiary starting from the acquisition date. So I'm asking, if we are consolidating on the acquisition date, what is the implication of that for sharing in retained earnings? What does that mean? What is the likely implication of that?
So would the retained earnings be written off? Like if it's sorry?
Very brilliant. Somebody said it means the parent has all rights to the retained earnings because the DOA, date of acquisition. Okay, let me go and read that. Sorry, because the date of acquisition is the same as date of consolidation. Not exactly, but somebody was saying something earlier. You said something about, can you please repeat yourself?
I said that the retained earnings will be written off.
Retained earning will be, meaning that it will be cancelled out. The pre-acquisition retained earnings will be, okay, we're going to see how that is going to take place. That was not even where I was going. Now, but I like that answer because it will take me there now. That pre-acquisition retained earnings, the retained earnings you are seeing in the books of ESCO as of that acquisition date, they retained those earnings prior to the acquisition date, meaning that PICO has no share. Are you getting it? PICO will have no share in those pre-acquisition earnings. As a matter of fact, because you are consolidating on that date, they will not be able to share in any profit from ESCO. Let's look at that. Okay. So we'll quickly notice here that unlike what we have been doing before, in an attempt to cancel out the investment that was made in ESCO, you would have seen that PICO is showing you 40,000, right? While the ordinary shares of ESCO is showing you 25,000. Now, when they acquired it on this day, they met 5,000 retained earnings. So meaning that they paid an amount to get the net asset. A net asset at this point in time will be the ordinary shares and the retained earnings, right? But even when we add that together, it makes 30,000 naira. But when we look at the investment is 40,000 naira, right? So if I were to cancel out this 30,000 against this 40,000, I will still have 10,000 naira left. That 10,000 naira left is on the asset side. It is what we call goodwill on consolidation. In fact, when we go into more complex questions, we're going to detail the workings. Well, we can do that now. What we normally do is to say, what was the purchase consideration? And this is what the acquirer or the parent is paying. If there is NCI, we will add up the NCI. and then we'll factor that against the net assets acquired. So this ordinary shares was acquired. We'll now ask ourselves, what are the other elements of equities that were already existing as at that date when we are making the acquisition? So as at the date we are making the acquisition, because this book is showing you 30 June 2017, and we are acquiring at that same day, it means that this 5,000 naira, this retained earnings, will come here. It is part of the net assets that we acquired on the day. If there's share premium, any other thing like that, all of that will be added all together, and then we'll take it away from the total of purchase consideration and NCI. Whatever we have left will be our goodwill on consolidation. You're going to see that in the notes. Okay? So let's move forward and quickly look at this so that we can push to the other questions. So we have already done the work. The purchase consideration was 40,000. The net assets that was acquired is the 30,000 we are canceling out, meaning that there's going to be a goodwill on consolidation of 10,000. Goodwill on consolidation means that this investment plus NCI is greater than the retained, greater than the net asset, this equity, as at the day of acquisition. Okay, now we can add up the current assets. This will give us 50,000.
Sorry, sir. Could you give us a difference? Like previously, we were when we're doing the calculation, we didn't experience this goodwill. Kind of give maybe what was the difference between that and now?
I'm not sure I understand your question. Can you please repeat your question again?
Okay, so now we're calculating goodwill. So the previous simple group, we didn't calculate goodwill. Was there a reason why? Or...
Okay, I get it. Okay, now this is what I'm saying. Purchase consideration. If I'm seeing investment in ESCO 40,000, it means the purchase consideration must have been 40,000 here. Do we have an NCI in this case? No, they didn't mention that to us, and we didn't see that implied, right? So, right, no NCI, 40,000. Now, net assets acquired. I said look up to, of course, when it gets more complex, we will see more things. For now, just look at the equity side of ESCO as at this date. The equity side, as at this date, we have ordinary share capital of 25,000, and then we have retained earnings of 5,000. If I add these two together, I have 30,000. Take that away, you have 10,000 naira as what? As goodwill. We're going to see the calculation was done. The solution is here. Okay? So when I come here, ordinary share capital of the parent is 37,500. All right? When I get to retained earnings, don't forget, we use this 5,000 to cancel out the purchase consideration because it was a retained earnings. All right. Let's look at one more question. Let's look at one more question. This will mean we will have to do more in the next class. Let's look at one more question. I want to believe we understand the goodwill aspect. Do we get it? Can everybody hear me? Did we get the goodwill aspect? How many people are left?
Yes, sir.
Okay. Praise, can you hear me now? Praise, can you hear me now?
Yes, sir.
Okay, Busola. Okay, all right. Let's round up with maybe one more question. Since I have been struggling, I've used like 3 different devices this night. I don't understand. Okay, we have goodwill and NCI. I'm going to skip this one. I'm also going to skip this one. I just want something a little bit. I want to focus on something that has pre and post acquisition retained earnings more. Okay, now let's look at this one. We're told PICO acquired 75% of the ordinary shares of ESCO on January 1, 2017, when ESCO had retained earnings of 7,500. Now, the market price of the shares of ESCO just before the date of acquisition was 1.6. PICO values NCI at fair value. Now, even if they did not tell me that PICO values NCI at fair value, the fact that they have just told me the market price of ESCO, they said the market price of the shares of ESCO just before the date of acquisition was a naira 60 kobo. Now, it means it is possible for me to get the full or fair value. Now, the examiner will most likely 99 out of 100 or 99.9% of the time, they will always tell you value at fair value. They will always tell you NCI is valued at fair value or the full value. Now, if that is the case, we have already explained how we are going to do this. So that shouldn't be a problem. But I want you to understand what they mean when they said ESCO had retained earnings. These 7,500 are profit these days that PICO acquired ESCO. Okay, now let's go and do our cancelling out. Now, the cancelling out will not be so easy to just cancel out on the face of the financials as we have been doing before, okay? But even looking at the face of the financials, I expect you to still be able to analyze what you need to cancel out. I know I'm going to cancel out this 34,000 against 25,000 ordinary shares in ESCO and 7,500 retained earnings that existed prior. I must understand that not all of this 12,500. Instead, it will be 7,500 that existed prior. Then again, I must remember that this 34,000 does not represent the amount paid for 100%. It was an amount paid for only 75%. Okay? Now let's go to solve. First thing I will want to look at, I have now understood the group structure, right? I already understand that, sorry, where am I going? That PICO acquired only 75%. That's the group structure. I already know that the date of acquisition is 1st January 2017. However, this time around, we are going to consolidate at which date? Just look at the statement they gave you. That will tell you the consolidation date. We have to consolidate. Go ahead.
I was just saying 31st December.
Yes, we have to consolidate 31st December 2017. Now, what does that tell me? It tells me that the parent, PICO, will only share, will only share in the profits of ESCO between January 1st down to 31st December 2017. So when they told me that as at the date of acquisition, ESCO had 7,500 naira retained earnings, they are trying to let me understand that I am going to use this to cancel out they are going to share in. Okay, so let's quickly do the math. We'll do the math by saying purchase consideration was 34,000. NCI was 25%. How many shares do they have in ESCO? Okay, they told me they have 25,000 ordinary shares of 1 naira. Okay, so those 25,000 shares, then I will multiply. Now, don't forget that they told us that the parent company will value NCI at fair value. So I'm going to take market price. Remember, I told you, if it were to be proportionate share, they would have done it at book value. Abi? Now, because it's fair value, it's going to be done at market price. 1 naira 60 kobo. So I'll do 25% times 25,000 times 1 naira 60 kobo. Anybody with their calculator there, airport, or we
10,000.
go and look at the solution?
10,000.
That's 10,000. Thank you. God bless you. Okay. And then I am going to use this 44,000 to compare what is the net asset that we acquired. Net asset acquired. I've told you, look straight to the equity side. Under the equity side, ordinary shares of ESCO were worth only 25,000. However, there's a pre-acquisition retained earnings. The pre-acquisition retained earnings was how much? 7.5. And now that amounts to how much? 32,500. Meaning we have 11,500 as our what? Our goodwill. Is that clear? We have that as our goodwill. So I'll start in my consolidation. Goodwill, how much? 11,000. PPE. And what the PPE we have here? Together, 30 plus 25,000. How much do I have? That's 55,000. Current asset, I will add the 26,000 plus the 17.5. And that should give me, is it not 43.5? Current asset, 43.5. Add 55 plus 11 plus 43.5, 66,000 plus 43.5. It looks like 109,500 to me. Are we still together? Can you hear me? Am I being heard?
Yes, sir.
Please use the chat box. Can we hear me?
Yes, sir.
Okay, good. So now, when we come here, ordinary share capital of the parent, because we have used this for cancelling out, that's 50,000. Now, when it comes to group retained earnings, get used to doing some workings. What's the working I want to do? The working I simply want to do here is this. Let me erase the earlier one. I will say, how much of the post-acquisition retained earnings? So what is all the retained earnings? All the retained earnings put together is 12,500. 7,500 had existed before Pico bought Esco. The remaining 5,000 is post-acquisition, right? So now, parents will be able to share in this 5,000. They will get 75%. Now that 75%, we've done it before, accounts for 3,750. The remaining 25% accounts for only 1,250, but it will belong to who? It will belong to NCI, right? Okay. Now, my retained earnings that I will consolidate for the group will only be the one that is belonging to the parent. So this will be 3,750. If you add this together, you should have 53,750. Now, my NCI, don't forget, I told you what is the original value of NCI. We said it was 10,000 when we did the workings. Abi, 10,000 plus the share of profit now, 1,250, making 11,000. 11,250. Making a mistake, the earlier mistake I made, because I was focusing on just the share. This is their share in subsidiary, 3,750. But they originally have how much? 35,000. Okay, so you add that 35,000, and that should give you 38,750. So 38,750. So when you add 38,750 together, to 50,000, that should give us 88,750. Okay. Our NCI, we said they're going to get 1,250. The calculation of our NCI original amount, was it 10,000? Is that 10,000 correct?
Yes.
We did 0.25 times, let me use my calculator, times 25,000 times 1.6. 10,000, correct. So 11,250 plus 88,750, that gives us 100,000. All right. Okay. What else do we have there? We have current liabilities. Current liabilities, if we add it together, that should give us 10,000. So here I have 110,000. What did I said? I have 109.
Yes, sir. The goodwill is meant to be 11,500.
500. Did I make any mistake up there?
The goodwill is 11,500.
My bad. Okay. Okay, let me run that back again so that I can be very, very sure. We did 34,000. That's the purchase consideration of the parent, plus 10,000 belonging to NCI, making 44, Abi. You minus that from 25,000, minus pre-acquisition 75. Okay, okay, I think I get it. Sorry, goodwill should have been 11,500. If that's the case, then we are correct to say it's balanced now. 110,000. 110,000. Done. We are beginning to get into shape. We are beginning to get to where I want us to get to and push forward from there. Okay. All right. Permit me, with the way things have gone in this class in terms of network, let us today. What I will do next week, I don't know if we can agree together to start the class earlier on Sunday to make up for this time. Maybe we can start maybe 6 p.m. 6 p.m. next week Sunday, and maybe we can do like a 3 hours, 4 hours full lecture proper, so that I'll take you across. You see, from here, if I do 4 more simple examples, I believe you would have recollected all your dealings with group accounts in terms of financial position. Then I can do maybe 2 more for profit or loss, and then we can go solidly, so that when we go into complex structures, I will not have any problems. We'll just ride together. This understanding is very, very important. What is the 2 things I said you must never forget? You must understand that in group account, the principle of cancellation, very, very important. Then after we have dealt with the cancellations, that's when we are going to add up. Now, it begins to get more complex, and you begin to almost want to forget that it is this same overarching principle that holds everything together. But no matter how complex it gets, you must always go back, rearrange yourself, and say, okay, what is the group structure? It will tell you a lot of things. It will tell you how you are going to share post-acquisition retained earnings and all of that. Number 2 is, what is the acquisition date? You must be able to differentiate the acquisition date from the consolidation date, because that tells you also how you are going to divide whatever is the retained earnings of the subsidiary. Then you can now move on to calculation of goodwill. Then you can move on to calculation of NCI. You see, all the extra things that they are going to add when we get to intra-group trading. We begin to talk of impairment of goodwill. We begin to talk about any other thing is just Jara. It is this same principle that holds everything together. Okay? And we're going to see more of it in the next class. Permit me to end this class right now, and then in the next class, we should have it more solid. So I want to ask, is there anything that we explained that you did not understand in this class before we go? Okay, if there is none.
Good evening, sir.
That will be all from me. Okay, go ahead.
Sorry, due to the nature of my job, I'm just coming in and you people are signing out. I don't know how I will get the recorded class, please, to help me.
You will get it. You will get it.
Okay, thank you.
The only challenge you have is the in and out of the network. We suffered that a lot today.
Okay.
But even that will be solved. What I plan to do is I have an alternative to a better internet that should be fixed before the end of the month. But today I've had to alternate between MTN to Airtel. It's been a mess. It's been a mess. But all of that will, as we go on, all of that will get fixed.
Okay, thank you very much.
Is there anything any questions for me? Everybody have a lovely week. And during the course of the week, if you have any questions, you have my phone number. You can reach out to me on chat. Just let me know whatever because I know that some of us we have our own peculiar issues that we may want to address. Okay, thank you very much.